Hello, everyone, and welcome to the Exit Ready Fundraising or Selling, How to Keep Both Doors Open. My name is Nina, and I'll be your host today. I'm a manager at Nextplay, where we help high growth founders with fundraising strategy, as well as M&A execution. And why you're here today is because across the C startup ecosystem, we're seeing a major shift. Founders are increasingly evaluating exits alongside fundraising. So today's conversation is about how to do that smartly without shutting either door too soon. And I'm excited to be joined by four brilliant speakers. So first we have Szymon Sip. Forgive me for my bad Polish pronunciation in advance, please.
No, it's very good. Thank you.
Great, I'm glad to hear. So he's a founding partner at SSK&W, the leading visa legal advisor in the region. Next, we have Paweł. He's an investor and fund manager with 60 plus investments and 20 plus exits, currently fundraising experts for profitable tech scale-ups. Then after
Hello,
that, we
everyone.
have Marcin Laczynski, general partner at Next Road Ventures, backing early stage B2B startups and a key voice in the region's VC landscape. And finally,
Thank you.
we have my colleague Martina Vitezova, managing director at Nextplay and M&A advisor to startups across the CE region and former investor at Unica Ventures. You'll get the opportunity to ask them directly questions in our 15-minute Q&A at the end of the webinar, so we can just get started with our discussion. So I first have a kickoff question for all of you panelists. The question is, what's one piece of advice you'd give a founder who just got a term sheet from a VC and a soft offer from an acquirer at the same time? What should they ask themselves? Maybe we can get started with Martina.
Yes, thank you for the question. I think the key thing that the founder should ask himself or herself, do they still have the fire in their belly to keep the hustle? Because the choice is actually rather simple. If you take the acquisition offer, you're changing quite a lot. You will be in a situation when you're giving up the control over your company and also shifting the risk of the business to somebody else, the acquirer. Whereas if you keep on with fundraising and building your business, then the hustle is on you. So the question is, in my view, how much drive and energy do you still have in you to make your dream, keep building it and make it happen?
Martin, do you agree?
Yeah, I agree. I think the main question is basically where you as a founder are in life. And if you have, what it takes to grind for the next couple of years, because taking money from the VC, it's basically, it's one message. VC wants you to stay in the company, grind for a couple of more years, so there can be a clear exit for the VC. And the clear exit for the VC means that you have to commit your time and effort and resources and actually your life into the company. So if you're in a different point of life, when you're actually thinking maybe more about family or some other things that you would like to pursue, probably the exit might be a bit more suitable for you. So yeah, definitely I agree with Martina. The question is where you are in your life, and that should simply dictate your next decision.
Pavel, have any of the startups that you're currently advising experienced that?
Well, they had the exact dilemma since actually the last client that I fundraised last year had exactly the same situation. They received an acquisition offer to sell the 100% of their business. And on the same time, they decided to go and fundraise the first round actually as profitable scale up. They had a dilemma if they should take the route of selling the whole business or do I believe in the business to still keep going. So on top of everything that Martina and Marcin said, which I fully agree, I would say it's also a financial perspective. So do you believe, having the offer on the table, do you believe that in the next 5 years, you can scale your business, let's say 3-5 times, 3-5-fold, and they have successful exit. So either you can take the money right now, but then you have to ask yourself, how can you reinvest or what will you do with this money? How can you will put it into work, or maybe how you spend it on your maybe private priorities that you might have. Or do you believe that you should take in the business for the long time, take the risk because maybe you believe you'll be able to scale, but maybe not. Maybe circumstances will change. Maybe the macroeconomy, geopolitics, maybe the competition technology. Right now, AI is a big thing, and then you hope that you will take in the next 5 years, the big payoff. So it's also the financial dilemma that you have to consider as the founder.
Szymon, I guess you've seen a lot of term sheets or offers, especially from a legal standpoint. What has been going through founders' heads and what kind of advice have you been giving them?
Yeah, so my first, so I completely agree what has been said by Martina, Paweł, and Marcin. But my advice would be bring a good advisor to the table, not only lawyers, but like financial advisors, or even like a mentor, somebody that you could talk to and evaluate the offers, because offer from the VC or from the buyer, there are completely like different offers with different consequences. And founders, they don't know the market standards, so they should, be able to have a chat, even if they don't want to engage financial advisor, legal advisor at the very beginning, but they should have an opportunity to chat and to evaluate with somebody whether this is a good offer, whether the conditions are, based on market standard, or this is just an opportunity for somebody else to bring money to the company or take over the company. So I would say, advisor or mentor is the key, I would say.
Okay, that's very interesting. Then we're going to start our panel discussion. And the first topic is going to be M&A as exit pathway in VC. So my first question goes to Paweł. And as you know, most startups exit via M&A, but IPOs and unicorns valuations still dominate the narrative. So do you think that M&A is still seen as a second best option by VCs or LPs?
Well, of course, it's a great question. Of course, we do have the stereotype of the great IPO, yes, especially in the US on the Nasdaq, with billions of dollars of valuation. Although it happens less and less often. When we look at the US statistics for last year, IPOs, it was about 20% of the total exit landscape in the US alone. Remaining 80% was other sources, primarily mergers, acquisitions, either strategic or financial. The remaining 10% was like liquidation. So maybe you just sell the parts of your company and the company stops to exist. So, but also maybe it's not intuitive, but you do not need an IPO to have very spectacular exit, especially if you are in a tech company building scale and having a great unique technology. You might as well have a great exit to a tech giant. Last year, everyone got excited about the possibility of Figma takeover by Adobe for over $20 billion. So you can have spectacular returns, and not only through IPOs but also through exit to tech giants. Just a few days ago, we learned about potential takeover by OpenAI of a company developing AI technology for $15 billion. So such exits also happen, but we have to know that they are very, very seldom. And we also have to be aware that most of the exits, especially here in this part of Europe, we have to remember that most of the exits are above or below 50 million euro. So, everyone has this dream of building and scaling technology, becoming unicorn, but most of the exits, most of the action, usually is somewhere around 50 or below. If you are lucky enough, you can have exit above 100 million. I'm come from Poland, Warsaw. So in Poland, look at MMAs. The largest tech exit that we had in recent times, like 100% exit, was Polish Applica AI being purchased by Snowflake. The value of the transaction was $180 million. And this is, to my knowledge, the largest 100% exit through M&A in tech sector, at least in Poland or maybe this part of Europe. So, and we do not have any examples of IPOs of companies from, for example, Poland or Nasdaq. Yes, we have UAPF, a spectacular exit or spectacular IPO on the US stock exchange. But this is the exception. Right now, we are waiting for more such examples. But most of the exits of the VCs and of the angels are through mergers, acquisitions, small mid tickets. So, you know, having dreams is one thing, but seeing what's possible out there and what's the most frequent is the other thing, you know, and getting ready for it. So I would say, yeah, we have to have big dreams, but also we have to remember the reality. Reality is that the IPO market in the States, it's becoming more and more difficult. The IPO market in Central Eastern Europe, it's almost non-existent. Even in Poland, where Polish market, IPO market used to be fairly vibrant, but we don't see it in the last 2 years. You know, once again, the IPO market, we can say it's that, you know, even by VCs and by founders, we do not look at Warsaw Stock Exchange as an exit opportunity, actually. So we think about the IPO in the States, but it's have seen even less than unicorn, or more seldom than unicorn, or just having merger acquisition.
Okay, I mean, that's very interesting. And I mean, based on that, Martina, I want to ask you the question, do you think that there is a need for a mindset shift in Europe around exits?
Yes, definitely. As Pavel said, I think M&A is considered a little bit like a plan B or fallback option for a lot of VCs and founders. And they don't, from my experience at least, it seems like almost, yeah, people don't want to talk about it. So almost as a taboo topic, not exactly, but yeah, getting there. And yeah, as Pavel said, like reality is that M&A plays a big role. IPO market is very challenging in Europe in general, especially in CEE. So I think that, for example, if you look at US and yeah, the way how ecosystem works there, there is much more emphasis on planning and executing a healthy exit, right? It's actually quite normal part of the life cycle of a startup to think about exit early on, because there's so much that startup can do to prepare itself. And, you know, it doesn't eliminate the IPO as an option down the road. So you can play both cards, and you can also keep fundraising as well as preparing for an M&A. There's things that you can do in advance, quite in advance, to have ultimately an option to have a successful exit. So I think it's M&A, it's part of a natural life cycle of a startup. It shouldn't be seen as a plan B or fallback only when things are, you know, difficult. But yeah, we should talk about it more in Europe as well, in CEE as well. And I think having a systematic approach, yeah, thinking about it in advance, preparing for it, can really drive the value and can bring about those really nice valuations. And especially in our region, but also in continental Europe, this is a great way how VCs can generate returns.
Well, it's good that
Since I love statistics, I'm sorry, Nina, I did not provide statistics. So for the audience to have some background, in the US last year, we had 146 IPOs of tech companies. I would say only look at the size of the ecosystem. In Europe, we had only 11 IPOs of tech startups.
Yeah,
of the whole ecosystem, look, hundreds of thousands of startups in the whole Europe, and 11
including
IPOs
UK,
in Europe, 140.
Paweł?
Yes.
Including UK, yeah.
Yes, I mean, the European market, when you look at it, is dead, basically. And it also happens very often. You have companies that were listed on the stock exchange in UK, in London, being taken off the stock exchange and taken to US in order to debut in US if there's an opportunity to do that. The other thing is that we have to remember that we have more than 1,000 unicorns today, and most of them are actually not listed anywhere. So we have paper unicorn. I think it's actually the actual number is 1,500. Which is a bit of crazy when you think about it. And where are the exits? And I would say for most of the 1,500 startups that we have, unicorns, sorry, that we have on paper, most likely exit is actually through M&A. I would say that IPO is highly unlikely for most of them.
But also, Marcin, so we should say that most of the probably 1/3 to 50% of these paper unicorns do not have unicorn valuation anymore if they would fundraise right now.
Yeah.
Secondly,
absolutely.
some of them are delaying the IPO since for the same reason that they do not want to face the reality with the valuation and the liquidity. So they postpone which we haven't seen it before. Even 5 or 10 years ago, when you had startups like SpaceX or with OpenAI with valuations above 100 billion euro or dollars, I mean, they would IPO having 10 billion valuation. And right now we see more and more startups postponing IPOs, taking money in the next rounds from private markets, from late stage VCs, private equity growth funds, even pension funds, trying to avoid the IPO market at all costs, which was unthinkable. Yes, 10 years ago was unbelievable to see it.
But I would say the light in the tunnel is the recent IPO of Circle. Because what we've seen that actually that IPO would show that there is actually money in the ecosystem. So fingers crossed, actually, this is the first sign actually that we are going to see some more play in the industry in the months and years to come.
That's, as mentioned before, it's really nice that we're talking about this. As you said, like, we need to talk about this more. Founders need to be more aware of these things.
But just one more thing, and I think it's just, I mean, you can hear it from what we are saying, that when we are talking about exit strategies today, and we talk IPOs, we're only thinking US. So this is something that is critical actually to take into consideration, that when you are actually a European founder operating out of Europe, it means that the most likely exit strategy for you is not IPO. It's actually through M&A.
But at the same time, it seems like, it's still seen as a fallback option, like plan B. It's as if you were not really going big, right? It's almost, some sort of fallacy to be thinking about M&A in some more active way. You're holding back almost, but actually, it's not like that. That's a great opportunity for you to, as a founder, to create a success and capitalize on it.
Yeah, but building what you, Martina and Paweł said, I have a question to both of you, if I may. So based on the current market, what's going on these days, would you advise a founder to go for like VC round or prepare for the exit? What do you think is the best option, having in mind the market conditions this day?
Who will start?
Yes. Go ahead, Paweł.
Martin. Okay. I mean, from my perspective, I usually discourage my clients, or before that, my portfolio company is taking, once again, VC money, unless they are certain of the positives and negatives, and they are fully determined, but they also see the path, because, we have alternative. I mean, there's a third alternative. We talk about the VC path, we talk about the IPO market, the exit or MMA, but the third path in the options is becoming bootstrap. So, we still have some pool of companies that never have, that build the scale, are profitable, never took VC money. And sometimes some of them have dilemmas. Should we enter finally after many years of being fully independent? Should we take the VC money? Should we think about the exit? Actually, this is the clients that I work with right now, helping them to fundraise. And my answer to this question, Szymon, is always the same. I mean, do you really know what kind of, how desperate are you to take this money? Do you believe that taking the VC money, for example, will help you incrementally scale your business? And do you see the advantages? Because, taking the VC path or taking the exit path also brings some negative consequences to the founders. You lose the control. You have some partner at the table with whom you have to discuss, usually who has the voice, especially in major decisions regarding the business, the corporate governance, or maybe the future exit that you have to take into the consideration. So especially the VC money are best suited for the businesses that, due to this money, can rapidly scale. But if you do not believe or are not convinced that taking this money will help you grow your business, let's say 100% year over year or 100% year over year for the next few years, maybe this is not a path for you. Maybe you should consider being a bootstrap. But remember that being a bootstrap, it's only state of mind. I mean, you can be bootstrap and then you can take VC or private equity growth money. You can be on a VC path and then to fall off this path and becoming bootstrap because you are not able to fundraise anymore. So you can be bootstrap at any point of time, and you can be on the VC path, private equity growth path, or being a bootstrap at various stages of your business cycle. But from my perspective, taking the money from the financial investors, it's only for the few that actually can take this money and rapidly grow their business, build the value, expand maybe through mergers, acquisitions, or organic growth. And then from the founder perspective, the positives overweigh the negatives. They can grow their equity, they lose some independence, but they gain the partner at the table, they can achieve their business goals. But this is the path maybe for the 5-10% of the tech companies overall. So I'm not saying that this is the path for everyone. I would say that you have to be fully aware. What are you getting into? Understand what does it mean to take the VC path or private equity growth path before you actually enter it. And as you mentioned, reading about it, learning about it, talking with founders who took this path, taking the mentors, taking the advisors, trying to get the feel for it and fully understand it before you decide which route to take. It's very important. And I believe that a lot of founders do not take this, they do not do their homework. I mean, they have this imagination of being a founder of a startup. I have to take the VC path. I have to IPO on Warsaw Stock, on NASDAQ or New York Stock Exchange. And there are some kind of stereotypes, and we follow the path without fully understanding what does it mean and what's the reality and what are the consequences.
There's also another thing actually that we kind of not take into account right now when we discuss, and it's the AI revolution that we are experiencing today, meaning that right now, you as a founder, you can be much more efficient with much less resources. And at some point, the question will be actually whether you should take money from VC to scale. Do you need it? Or there's another also thing, and this is something that many VCs are also afraid of, that founders, and this is the strategy that they keep for themselves, and they don't share it with the fund, but they assume only getting 1 or 2 rounds, not more. Because they know that within a certain amount of financing, they will be efficient enough actually to continue their growth without taking additional external financing. Yeah. And for some VCs, that might be also not the perfect path as well. So, yeah, we're definitely living in very interesting times today.
Well, on that note, I would actually like to ask Martina the question, since we're talking about exits, but also exits versus fundraising, so to say. What can smart founders do to position themselves for both fundraising and acquisition without risking momentum?
Yes, so maybe just to add to also the question of timing of M&A, what we've been discussing so far, I would like to say that when a founder is thinking, fundraising or M&A, it's also important to think about market timing. So sometimes there are moments in the market when it really makes sense to start with M&A process. So it could be, for example, that there's a consolidation wave going to happen, or it's starting to happen. These are great insights that you should keep eyes out on, or talk to experts to have a feeling when it's going to happen, because it always pays off to be the first acquisition in a consolidation wave than the last one. Mm-hmm. Then there's the most buyers interested, then you are there for more competition, you're most likely to get the best offer. Also, if you're sort of like at the end of the wave, if the first acquisitions didn't play out that well, then the remaining buyers might be much less likely to give you a good valuation. There could be also some sort of like inflection point in the journey of your startup. Let's say if you got some patent or some regulatory approval that allows you to enter a huge market. So also keep that in mind when you're debating VC or M&A or what should I do. And back to your question, Nina, what can a founder do to get ready for M&A, but still keeping all the options on the table and not somehow closing any of them, there's one key recommendation, and that's build relationships with your potential strategic buyers, right? So here I mean either your competitors or some adjacent players in the industry who could really benefit from acquiring you. I would recommend just simply make a research, build a list of top 10 or 20 or as many as you find stakeholders that in some way could derive synergy from working with you, and start building relationships with them. I'm not saying to talk about M&A. No, I mean, if you're still not sure about it, right, this can really also scare off your investors and so on, but leave it more in the back and talk to them about partnerships. Because when you have these strategic companies that know about you, have worked with you on different projects over a longer period of time, they trust you, right? You have to keep in mind these are large corporations. They're not used to working with startups. They don't understand what is the startup hustle all about. They want to see stable, reliable companies. So the more time you can spend with them and show that this is who you are, a stable, reliable, solid company, and the more evidence you can give them that, look, these synergies are actually real. So look at this project we had together, or this joint venture, or some sort of commercial partnership. It really gives them this tangible evidence that, yes, this merger actually can work. And then, but all this time you're not talking about M&A. You're just talking about getting to know each other and working together on interesting projects. And then at one point when actually you decide to do an M&A, and hopefully you time it right, like I said at the beginning, there's also other factors like markets incentives or some internal drivers that the M&A could really work. Then you already have a whole list of huge companies out there that know about you, that it's just a matter of like setting up an email with a meeting with an email with their CFO and opening this conversation. And that will make for a much faster deal, more likely to have better terms and better valuation. And I'll highlight last point that the faster the deal, the M&A deal goes, the more likely it is it will close and you will get the best terms. Because the more the deal drags on, the more the signal is that there's not that many interested buyers. It's a slower case, slower situation. So whenever you are talking about M&A with somebody, you want that process to be really fast and structured.
I have actually one question related to the project to you. So imagine that I'm a founder. What's the best practice actually of building the pipeline of those partners? So should they turn to guys like you who basically advisors, or should they do it themselves? What's the best procedure? Because I mean, I know the process in US, but I think in Europe we are still kind of learning. So from your perspective, what's the best thing for the founders to go?
I think that both options can work. A founder can start building these relationships themselves, but then, there's always a little bit like hidden elephant in the room, right? When are we going to talk about M&A? What would this partner need to see so that I'm like a good candidate for M&A? What if I had this product feature or presence in this market? Would that make me a more attractive case? So essentially, a founder can have these conversations on their own, and that can work well. But if you have somebody in between, like a neutral party, I as an advisor, I can just approach a buyer anonymously. They don't even have to know that I'm representing a startup, and I can really learn from them. And this is actually what I do in my work, that I talk to buyers all the time, and I have these insights. I know what they're looking for, what is their M&A appetite, what is their strategy. So these sort of insights, if you still have that runway, and if you can still make some significant strategic business changes in the way how you run your startup, that they can be also very helpful, and perhaps are a little bit more challenging to collect for a founder on their own. But ultimately, yeah.
One more follow-up questions, guys. Sorry for invading your space here, but I would also learn, from your perspective, the potential buyers, acquirers, how open they are actually to open such discussions with yourselves, with the founders. Are they, relatively friendly and open, and they're actually willing to have these discussions, or they're more closed, and you really need to build a relationship with them in order to get all the information that you require?
Yeah, if I may take this one, just so in my experience, they are very open. And what I also see is that sometimes they have a very clear strategy, what they're looking for, and they're happy to share and they're excited to have this conversation because, you know, there's also, it's their job sort of to know and find nice opportunities for acquisition. And on the other hand, sometimes maybe they're not so clear about what they want to acquire. So to have these conversations early, you actually indirectly help them shape their M&A strategy. So when they are aware what's out there, what's possible, and how it fits into their business, this can be a relevant input for their own decision making at the board level. So yes, definitely you can reach out to them. Usually they're very open to this, and they're at different stages of how mature their M&A strategy is. It's always evolving and it's a dynamic topic, but you can be part of that conversation with them sometimes even.
All right, cool, thanks.
I mean, it's super cool now because we've really had a deep dive into especially like the M&A perspective. So I would actually like to follow up on that almost and ask Marcin how important do you think is it to have a clear exit strategy to investors during a funding round?
Very. I mean, it maybe not as a founder. It's important for the investors to have a clear exit strategy and then kind of align it with the investment target they have. Because I will tell you, right now I'm wearing the VC hat. So from my perspective, whatever kind of investment I make, I need to see a clear path for me to make money off that investment. And I would say for most of the investments that we make, we are looking for fund returners. And then if I'm looking at, but on the other hand, I'm also an early stage investor. So I have to take into account, many variables that in the end give me the potential or reinforce my belief in the company that this company is going to return my fund. Because only in that way, actually, the investment makes sense to me. And I would say this is the case for most of the funds, the investment they make in a particular company, it's with the assumption that that particular company is going to return the fund. And in order to return the fund, I as a fund manager, I need to have more or less some sort of understanding how the exit may play out. And honestly, like looking at my investments in the region, I actually never assume IPO. I assume M&A. And then having that in the back of my head, I start doing my work just looking for benchmarks, see how historically a given vertical or given industry performed, what are the trends, what are the buyers usually paying, and then trying to put myself in the same spot 9 years down the line, trying to imagine, is it going to be the same or how it's going to change over time? Because also for us, when we're looking at VCs right now, I think especially for the early stage ones, the time from the first check until the exit, usually right now it's 9, 10, sometimes 12 years. So we have to be very patient. And this is something also that we have to take into account, that this is a long-term game. And during that period, if we were to, if we were to exit from the investment, we need to have a bit of an understanding how and on what terms it could and it should happen.
But also, I mean, it's great that Marcin, you added this perspective, of the financial investor, that actually, yes, we look at the extended timeline to exit. Yes, used to be 5 to 7 years. Right now, we say probably 7 to 9 to 10 years. Yes, since startups stay longer.
Common.
Exactly. But also we have to keep in mind that the company that will buy us, either the financial investor, private equity, buyout fund, or maybe strategic investor, or maybe this IPO, which happens less and less often, these investors will, at the moment of exit of the transaction, will still have at least this 5-year perspective. So if the VC invests right now, they look at let's say this 5-10 years perspective, plus 5 additional years that the acquirer will have to believe the company still to exist, to have technology, to be able to scale, to grow. So from today's perspective, if there is a financial investor that invests in your startup, let's say early stage VC fund as Marcin, he has to look actually 15 years from now. He has to believe in the 5-10 years lifetime that the company will be growing, still the market in which it operates will be growing. There will be good environment and good the positive perspective in the eyes of the potential acquirers. But also the acquirers will have to believe in the company at least for the next 5 years. Otherwise, they will not put money on the table. So, this is the game that you are playing as the founder. It's 10, 15 years game, actually.
Yeah. And then also you have to take into account this dilution on the way as well. And, like right now, I think as a rule of thumb for early stage investors, the rule is that you get diluted around 50%. But according to some calculations I made recently and looking at some new benchmark in US, it's actually dilution might be 75% for early stage investors. So this is also something that you have to take into account. And again, it's a part of the VC math. So yeah, exits are definitely important for us. So some sort of understanding how we would like to exit and make the money is definitely of value to us.
Then I have a follow-up question to that because founders might be scared to mention exits to their VCs. So what do you think is the right time for a founder to raise an exit possibility?
I would say everything depends on where the company is. Because if the company is on a, on a rapidly growing trajectory and, the company is actually rapidly scaling, I don't think that anyone thinks about exit. Maybe, or if the founder is burned out, but this is rather seldom. But if your trajectory is super positive and you're going like SpaceX rocket, you just continue basically, and you don't think about the exits. And then neither VCs or, the founders consider it. But when you are in a relatively good business, but your growth has stalled, this kind of exit thoughts, they appear both often they appear both on the VC side and on the founder side. So then I think you have to be open. And looking at the portfolio of a VC fund, usually you have to remember that you have 2-3 companies that will make the fund returners. You have approximately between 30 to 50% companies where you will lose money. And the remaining part, these are the companies that are actually going quite okay, but they are not really VC grade. You make a cash on them maybe 2, maybe 3 times. And these are the companies that you would like to exit relatively sooner than later, because anyway, they won't return you as much cash as you need in order to return your fund. And if you are a founder in a company like that, so company growing but not hyperscaling, I would say the time to say to mention the exit opportunities to your fund, to your investors. Actually, funds are open basically to this kind of discussion. And I have right now situations like that in my portfolio. So, and this is actually founders coming to us saying, guys, we actually see some potential exit opportunities. Would you consider? And yeah, we are open to it actually.
Plus, we have to remember that it's a matter of timing. The markets, the public markets, the private markets, they move in cycles. During the pandemic, especially end of 2020, first half of 2022, we saw this tech bubble. The valuations exploded. There was a lot of cheap capital on the market, a lot of so-called tourist investors without any prior experiences who were also investing. It was let's say the founders or the startup market. We could fundraise a lot with high valuations. We have seen high valuations on the public market. The revenue, the multiple on the US stock exchange for the SaaS companies was about 19 times annual revenue. Right now we are at below 7 times annual revenue. So the valuation exploded. The valuations of the MMAs, the valuations on the private markets, including the financial routes, also follow the route of the public market. So it was actually a great time to fundraise or to sell. Right now, after the tech bubble bursted, the valuations rapidly decreased. Right now we are somewhere in the long-term average. So right now we are at the stage where we were before the COVID, the tech bubble. So either the valuations are depressed or either the valuations are extremely high. So probably this is seldom seen like a natural balance market for the valuations. But of course, there are some sectors like AI sector right now, to some extent space sector, dual use defense, where the valuations are fairly elevated. On the other hand, there are some sectors, if you work right now as a startup in EdTech, for example, or to some extent, let's say, the NFTs, the valuations are on their historic lows after being very elevated just 2 or 3 years ago. So it depends on the macroeconomic timing, but also on the sentiment to the sector in which you are working. And the investors, they shift their preferences. Few years ago, the crypto, the blockchain, the NFTs, right now, the AI, and we don't know what will be overhyped 3 or 5 years from now. So it's a matter of timing, sometimes a matter of luck, to which you do not have full control as the founder as well, or the investor.
All right, I'd like to shift the discussion a bit back to this exit versus fundraising, so to say. And I would love a legal opinion on one thing. So, Szymon, how is preparing for fundraising versus preparing for an exit different legally?
So this is a very good question, and I'm open for comments of other participants here. But my impression is that 90% of the founders and companies are not preparing for either funding round or exit. So it's usually the case where the company or the founders will get draft term sheet for like M&A or for funding round, and then, unless of course it's not like organized process or they have no advisors, which is usually the case, they are starting preparing the documentation, because M&A or funding round begins with due diligence from investors or M&A buyer side. And then the founders are, trying to prepare documentation so that they are ready for due diligence, but it takes time, right? So they are not prepared. Now my takeaway for founders would be just prepare for it in advance, so the whole process will go smoothly. Building up what Martina said, that the M&A should be a smooth process, and the longer the whole process takes, there are more and more risks that it will not materialize, and the potential, for instance, buyer will go away without executing the deal, which is the case these days. So the preparation is the key, and the documentation for due diligence should be in place. And then the second point I want to make is that the legal documentation for M&A or VC round, these are like completely different standards. Just one point, that M&A documentation is the result of allocation the risk between the sellers and the buyer. Where we have VC documentation, the relations are different. So there is company and the potential investors, and the founders are just a part of it, right? So there are different relations included in this documentation.
So in that note, actually, if we go a bit more in detail, would you be able to give 5 key points that could be in a term sheet or a shareholder agreement that would help preserve exit optionality for founders?
Yes. So my key points would be first, whether there is a drag along clause, so the founders can actually exit with other shareholders. But to be also transparent, this provision is almost never triggered. But this is just it shows intention of the shareholders. The second point would be look at the liquidation preference, so whether the exit is a good or bad exit, because it may result in the price that you are getting in exchange of shares. Another point is that whether you are going to exit fully, like 100% of shares, or there will be partial exit, so you are selling majority of shares with potential earnout in the future. So another timing issue, so whether you are committed to stay with the buyer for another like 1-2 years and grow the company with this buyer, And last thing, the rules for liability. So with this M&A transaction, there is allocation of risk. So usually the sellers will be liable for like representation and warranties. There are some indemnification provisions or corrective actions, and they may influence the price that eventually the sellers are getting. So this would be the main points to take into account.
Those are great. Those are extremely valuable. Thank you so much, Szymon. So since we're approaching close to Q&A, I would like to first invite the audience to start drafting the questions. And I have a final, let's say, quick fire round where I will ask one question and then all of you will have one sentence to answer. So the question is, raising or selling, which mistake is more painful? And I would like to start with Paweł.
I'm trying to think how to interpret your question because I mean, selling the company if you sign the wrong if you take the wrong offer from the table, if you decide to sell instead of fundraise, when you sell usually 100% of your business one time, or it's spread over the time.
One sentence, Paweł.
Yeah. And if you fundraise, usually the dilution is about 20%. So I would say the mistake that hurts the best is taking the bad exit deal, because there's no backing out.
All right. So Paweł says bad exit. Does someone else say something else?
Bad investment, definitely.
Bad investment. Then why is that the case?
Wrong investor may kill you and your business. I mean, you, quote unquote. But yeah, I'm more bad investor.
All right, Szymon, what do you think?
I think the exit. So I'm building also what Paweł said. So if you have a good offer at current market conditions and you don't sell, then in 1 or 2 years the multipliers may be a bit lower, as Paweł mentioned in the SaaS companies, and then you'll be like complaining the whole time that you could have got like 100 million euros for your company and now you are getting like 15 or something. So in legal words we would say like unrealized profits or lost profits.
Yeah.
But they will be not coming, right? So
All right, curious to think what Martina thinks then.
I mean, bad investor hurts for sure, but I will also side with the exit as a worst mistake, bigger mistake to make here, because once you fundraise, I mean, if there's some bad terms, you still have chances with future rounds or with the exits to somehow correct and recoup some lost value if the valuation was lower, or if the investor was bad, maybe you can dilute them. I don't know, but yeah, with exit, it's once in a lifetime or a few times in a lifetime, make it or break it kind of deal. So if anything is not really well fine-tuned there, and also I think it's like as you fundraise one round after another as a founder, you get better at it because you learn how to do it. But with exits, oftentimes founders don't have so much experience, so actually it's also maybe easier to make mistakes here too. Yeah, but in any case, I would say exit definitely is the one.
And also, if I recall talking to the founders or shareholders that exited companies, I cannot recall that somebody would complain, like they just, at least those that got cash, right? So they cashed out, but either it was like 1 million euro or more, they all seem happy, that built something and got money in return of it. Of course, it could be like 10 million euros, but to be honest, I haven't talked to anyone that would say, "Oh, I sold this company. I'm so unhappy." So,
All right.
Well, but there's another topic for a separate discussion: the life after the exit. And I know the founders that they exit the company, they had no idea for what they do with their life and what goes to set. Plus, they have no financial plan, and some of the money that they reinvested, being successful founder, they said, they'll be like Midas turning everything into gold, and the hard-earned money over the years, they sometimes too quickly reinvested into various assets without any plan. And a lot of this money went, down the drain. So, it's as I said, another topic for another meeting. But it's also something to consider when you think about the exit. Do you have the plan for yourself, but also for your money? And take it slowly and plan for it as you plan as the founder for the company. And the founders that actually plan for how to build the company, how to scale the company, then they exit and they forget all the value that they have and the knowledge they have, and they are like charts in the fog to some extent. So, yeah.
I actually agree, Pavel. I think that moment of planning, like what to do after exit, is really important. And there's also a bit like a human element to it, right? It might be sometimes even scary for some founders to say, I've been building this company my whole life. Like, what do I do then? Like, I can't just go fishing. So it always helps to have like a plan for what happens next for yourself so that you feel more comfortable with the decision.
If I may comment, because I had an interesting conversation with one of my clients, and he said that I'm not selling the company for the next 10 years. I asked why. Because my friend sold the company and now he is very fat, he's bored, he's watching TV, and I don't want to be like him. And I said, oh, that's a new perspective. But I think it's, what Martina and Paweł, what you said, you need to have a plan. What's the next for you, right? Especially if you are a young entrepreneur, you got some money. You don't want to end up like watching TV or, yeah.
So here's to not becoming fat and bored after having a successful exit. All right, so on that note, I would like to open the Q&A for the audience. So if you have any questions, you can submit them. I will then select. If you wish to speak up, you can put your hand up and I will allow you to talk, or else I will just read the question for you. So I will be waiting. Give you a minute to type. There is one question, but it has already been answered by Martina in terms of how early founders should start building relationships with potential acquirers, even if they're still fundraising. So as she mentioned, you should do it as early as possible. Just get to networking, build those relationships so that they see that you're a serious, stable company owner, and then that will work on by itself.
But it's not waiting for another question. It's not only networking, but looking at successful exits that I have seen, especially of European startups to the even NASDAQ listed companies in the States. They not only build the networking, but they actually chose the potential acquirers. They made the conscious decision with whom to whom I would like to sell to. They had like a few potential targets. And then they started integrating the products, selling their business, which means integrated technology, selling to these companies, and actually hoping the other way that at some time, these big corporations, maybe by themselves, they come to the conclusion, this is a great partner, great supplier, maybe we'll buy them, acquire them before they will exit, yes? And it gives you a great negotiating advantage when the potential acquirer comes to you. You are not coming to them, but actually they come to you, so they have to set the terms, they have to ask the first, put the offer on the table, gives you great negotiation advantage. So, and of course, always, as Martina said, always, when you have built the relationships, when you actually yourself make the decision to sell, you can come to them, approach them and say, okay, you've been a great partner with us, right now we are selling, maybe you'll be interested of acquiring us. So, having this business relationship, not only personal relationship, really helps you are much more trustworthy. They know you, they see the benefits maybe of acquiring you, how to even further maybe integrate the technology or the product services that you are offering.
Okay, that is great. Here we have another question that talks about convertible rounds. So can early convertible rounds complicate an exit later on? And what should founders clarify upfront?
Szymon, question to you, I guess.
Depending on what's included in the convertible loan agreements, but usually there is some kind of automated conversion. So once there is an exit, the loan note holders, whatever you call them, they would just convert before the exit and got shares. But of course, it depends on the contractual provision. Sometimes the loan providers can forget about the exit and they will just be repaid with like interest, but will not participate in the exit. But from founders or company perspective, I would say that would be beneficial, right? Not to have this, triggered automated conversion. So, but generally speaking, I don't see that this is like obstacle or it's a complication or because of convertible loans, somebody will not perform the exit. I don't think it's a deal
I would say,
breaker.
from my perspective, it's a bigger problem for the seller rather than for the buyer, because the acquires basically agrees on a certain price, and conversion of the convertible notes is just going to dilute the shareholders of the company. So the issue is not on the buying side, it's more on the seller side.
Agreed.
Okay. I think, Pavel, you were talking about bootstrapping before. So there is a question about bootstrapping. Is there a different approach to exit strategy for bootstrapped versus VC-backed companies?
I mean, on one hand, building the exit strategy, I would say that it doesn't differ from anything that I and Martina have mentioned. You have to think, a few years ahead, build the exit strategy, build a relationship, or think about the advisors or mentors that you hire to prepare for the process. Of course, if you're bootstrapped, you have it easier since it's in your hands to make the decision. You don't have to you don't have these partners at the table, angel investors, VC funds, or private equity growth funds that, depending on your investment agreement, might have a voice at the table in the decision process. So either, as Szymon mentioned, the investors might have drag along, which might force you to sell the company even when you don't have to, or maybe at least you need the acceptance of the investors, maybe majority vote has to agree on the exit and the offer on the table. When you're bootstrapped, and let's say imagine that you are the only shareholder, it's only your decision. So you have more elasticity. On the other hand, you have to remember not to glorify the bootstrap, because the bootstraps as everything, it's not all black and white. Bootstrapping usually means that you have much more difficult because you have to compete with well-funded startups with VC money that they are well-financed, so actually they can scale more rapidly. But from the market perspective, you still have to compete with them.
I'm disagreeing with you right now, because I think that the AI is evening up the playing field. I think right now you can, in terms of marketing, you can be very efficient with less funds. In terms of IT, the same. So I wouldn't be so negative about bootstrap. I think the advantage of bootstrap company is, and this is something that you haven't mentioned, is that you are not diluted. And this is I would say this is the main advantage when you are thinking about it, because you can, since there's no dilution, you can sometimes think about exit earlier, because there is basically no equity that you share with anyone, and you can, even though you exit earlier, you can go out with more money in your pocket.
No, I mean, to highlight your point, you are fully correct. Startup after like round D or E, so like a large scale up, the founders at IPO might have below 10% of the equity, and additional probably, and at probably around C and above, the employees on ESOP, they will have more equity than the founders. The fun fact. So are you ready for it? That you have as the founders, let's say that it's more than one of you, usually it's 2 or 3 founders, that you have less equity in total than your employees, probably after Series C. And when you IPO, you have below 10%.
So you can have a spectacular exit, but not so much cash in your pocket.
I would like to finish with one last question from Vladimir. And his question is, did you invest in a startup which is not suitable for VC, for example, growing slower but steadily? And what made you do it? Did you consider safer exit at some point or something else?
I mean, I will say from my perspective, I mean, since we're a VC, we're doing only VC grade investments. So from me, no, but along the way, it happened that some companies basically slowed down, and then we're looking for the right exit opportunities for us.
Yeah, as a former VC, I can also say that no, because we always were looking for those huge opportunities, unicorn potential startups. But of course, that in reality, statistics are at play, and a lot of the companies ended up growing slower. And some of them were really successful, some of them a little bit less. But that's at the beginning when you're making an investment as a VC, you have to see that there's a chance the startup will be a really great success. Otherwise, it doesn't make sense for you to invest.
All right. Then that is it for today. Anyone that had any questions left, we will be sending the LinkedIn profiles from each of our speakers, so you can always reach out to them and ask them the questions. So I wish you all a lovely afternoon or evening, and see you next time.
Thank you for being here.
Bye.
Thank you very much.
Bye-bye.
Bye-bye.